Okay, hello and welcome to today's session. Now, in today's session, we are going to attempt a question from MAR-JUN 2023. That's called LAPIS Company. So I will be reading this LAPIS Company question and I will get back to you. It is 1st July. You are an audit supervisor with Indigo and Company and are planning the audit of your client LAPIS Company for the year ending 30th September 2005. Forecast profit before tax for the year is 68.9 million and forecast revenue is 192.3 million. Audit manager has attended a planning meeting with the finance director and has provided you with the following notes of the meeting. Planning meeting notes. LAPIS Company manufactures televisions at 6 factories located across Europe and purchases most of its raw material from overseas suppliers. These raw materials are shipped directly to one of the company's factories, and goods are usually in transit for up to 6 weeks. LAPIS has responsibility for goods in transit from the point of dispatch from the supplier. Company's internal audit department undertakes control testing across all factories, visiting each site at least once a year. Audit manager has discussed the finance director that the external audit team may rely on controls testing, which is carried out by internal audit department. Okay, internal audit department undertakes testing at factories. And the audit manager has discussed with the finance director that the external audit team will rely on controls carried out by internal audit department. So testing is done by internal audit department. And it is being said that the external auditors will rely on the work of them. The company sells televisions to wholesale customers and directly to individual members of the public via company's website. So you are selling television to customers and individuals via website. A significant wholesale customer has recently informed LAPIS that it is experiencing financial difficulties. However, finance director indicated that an allowance for receivables is not required in the year-end financial statements. Wholesale customers are experiencing difficulties and finance director is saying that allowance is not required. LAPIS offers customer a 3-year warranty on new televisions purchase. Finance director has confirmed that warranty provision will remain at similar level to prior year. In December 2004, LAPIS changed one of its television speaker suppliers to a cheaper alternative. This has resulted in increase in warranty claims. So warranty provision for 30th September 2005 will remain at same level prior year. But in December 2004, last year, you changed your supplier to a cheaper alternative, which has increased warranty claims. So I think the warranty provision should be revised. In May 2005, a payroll clerk was dismissed after it was discovered that they had carried out a number of fraudulent transactions. Controls have since been implemented to prevent this reoccurring. The finance director has informed the audit manager that she only intends to disclose the amount of remuneration payable to each director in financial statements. Local legislation in the country in which LAPIS is based requires disclosure of names of directors and total amount of remuneration. The finance director says that we will only disclose amount, whereas local legislation says that names and total amount payable must be there. One of LAPIS suppliers is offering company an annual rebate on the condition it purchases the minimum number of units by 30th September. The amount of rebate will be claimed in November 2005. It is likely from orders placed to date and forecast orders that LAPIS will exceed the minimum volume required to claim this rebate. However, it is anticipated that draft financial statements will include a receivable of 0.8 million. LAPIS is developing. A supplier is offering a refund, and you have been told that there will be a receivable of 0.8 million in the form of refund. LAPIS is developing a smart television and a 1.6 million cost incurred to date will be capitalized with intangible asset. This model is still under development. It is not expected it will be available for commercial production until 2006. In order to finance the development of the new model, LAPIS secured a 2.5 million interest-bearing loan. This is repayable in arrears. The directors of LAPIS are intending to propose a final dividend once financial statements are finalized. Okay. Requirement A, in line with ISA 220 quality management for audit, describe auditor's responsibilities in relation to supervising and reviewing the work performed during external audit. So you need to tell in ISA 220, auditor's responsibilities in relation to supervising and reviewing the work performed during external audit. So what are the auditor's responsibilities with respect to supervision and reviewing? The auditor is responsible to supervise and review work performed during audit. Okay, auditor is responsible to supervise and review the work performed during audit. So what are his responsibilities in relation to supervising and reviewing? Okay. During supervision, he must review progress. He must review progress of audit in relation to audit plan, which means ensuring that audit is going according to plan. This is his responsibility in supervision. During supervision, he is also responsible to ensure appropriate action is taken to address any significant issues occurring during audit, like there is a dispute between audit staff and management is not providing them information, so this is a significant issue. It's his responsibility to ensure appropriate action is taken. Okay. So his responsibilities during supervising and reviewing were asked. So we wrote 2 responsibilities during supervision. During review, this is the overall review. He is responsible to review work of the team and analyze whether it is in accordance with ACCA's and other regulatory requirements. So during review, he's responsible to check whether work is in accordance with ACCA's or regulatory requirement. He is also responsible during review to ensure sufficient appropriate audit evidence has been obtained to provide an opinion. Okay, so these are the auditor's responsibilities in relation to supervising and reviewing the work performed. Okay, during supervising, you need to tell his responsibilities in relation to supervising. In supervising, his responsibility is to review whether progress is as per plan. He's also responsible during supervision that if any issues arise, he must bring them to resolution. During review, he must ensure that sufficient appropriate audit evidence has been obtained. During review, he must ensure that whether work is in accordance with ISAs. Okay, so I've written his 4 responsibilities during supervision and review. Please copy them. Okay. Okay. Now, one of the most repeated requirements, 8 audit risk and auditor's response to each risk. For we will write the easy ones, because in question there are always some easy risks which are repeated every time, majority of them, and a few new. Okay, so while reading, I have found a risk. I will first start with the easy one. That's my strategy. The company secured a 2.5 million bank loan. The company secured a 2.5 million bank loan repayable in installments. You all know when we raise equity, there is a risk that the split between share capital premium is incorrect. When you take a bank loan, there is a risk split Remember, this has been repeated 1,000 times. Okay. Response. The audit team should ensure that 2.5 million loan was actually received. In addition, the split between current and non-current liability needs to be reviewed, and it must be ensured that all disclosures of loan are in accordance with relevant standards. Okay, so an old point. Another old point. A customer has recently informed LAPIS it is experiencing financial difficulties, but finance director has indicated that provision is not required. A significant wholesale customer is experiencing financial difficulties, but finance director has said that provision is not required. Okay. There is a risk that receivables are overvalued, or you can also write provision is understated. Okay, receivables are overvalued or provision is understated, both are correct, because you have failed to recognize the provision. Okay, if you have failed to recognize the provision, that provision is understated because customer is experiencing difficulties, you need to increase provision. You haven't increased, provisions are understated, that means receivables may be overvalued. Okay, we need to know the response to detailed testing of post-year and cash receipts and review aged debtor analysis to assess valuation of receivables, particularly in respect of significant customer, because there is just one significant customer, one significant wholesale customer who is experiencing difficulties. So you can do detailed testing of posture and cash receipts, review agent analysis, to assess valuation for this particular customer. Another easy point. The company changed one of its suppliers for a cheaper alternative, which has resulted in increase in warranty claims, but finance director has confirmed the warranty provision will remain same. As last year, there is a risk that warranty provision is understated. As increased claims should have resulted in increase in provision. You see, the company has changed its supplier and the warranty claims have increased. So you should increase the provision. But the finance director is saying provision will remain same as previous year. So there is a risk that warranty provision is understated. Okay. So you have discussed this in redundancy provision as well and other provisions as well. Response. Discuss with management the basis of warranty provision and recalculate the warranty provision. Okay, so I've got 6 marks till now. You can copy them. Okay, and then I will move forward. 2.5 million on very easy point. Finance one customer is facing problems, but you have not increased the provision, so provision is understated, receivables overstated. Do detailed testing of portion receipts. 2.5 million loan was received, split was correct, and supplier was changed, warranty claims increased. You didn't increase warranty provisions, or risk that warranty provision is understated. Discuss with management the basis of provision and recalculate the provision. Okay, please copy, then we will move forward. There is one new and very easy point which I want to tell you. The finance director has informed the audit manager that she only intends to disclose amount of remuneration payable in the financial statements. Local legislation requires disclosure of names of directors and remuneration. So finance director is telling you that we only intend to disclose amount of remuneration, whereas local legislation requires names as well as amount. This is a new risk. You can keep it for your practice. The finance director has informed the audit manager that they will include only amount of remuneration paid to directors in financial statements, whereas local laws require names of directors as well as amounts. Okay, finance director is saying that we will only include the amounts, whereas local legislation say that we want names as well as amounts. What is the risk? There is a risk of non-compliance with local laws. Hence, financial statements may be misstated. Okay, very easy point. That the local law says that you need to mention names and amounts, but finance director is saying we will only mention amounts in financial statements. So you're not complying with local laws. This is a compliance risk, non-compliance risk. And financial statements will not be correct. It will be misstated because you are not complying. Discuss with management the requirement of local laws and request them to amend financial statements to include names of directors as well as amounts so that financial statements are correctly stated. Okay. So whenever you say that law says this and you are doing this, it's a compliance risk of non-compliance. And you can discuss with management that these are the local laws, ask them to amend FS so that names and amounts both are included. Okay. So we have done 4 risks. Please copy them. Then we will move forward. Okay, now there is a 5th point because we have to write 8 audit risks. So the fifth risk, the directors are intending to propose a final dividend once financial statements are finalized. The directors are intending to propose a final dividend once financial statements are finalized. So they're just intending this. There's just their intention to propose a final dividend once financial statements are finalized. So there is a risk that dividend is recognized in financial statements. Hence, liability may be overstated. Okay. Response: discuss with management and confirm this intention of dividend will not be recognized in financial statements in liabilities. Okay, so directors are planning to announce a dividend, to propose a dividend. There is an audit risk here that you may include it. They have not yet announced. You may include it in financial statements that we have to pay liability, and liabilities may be overstated. And response: discuss with management that this will not be included as liability in the financial statements. Okay. Okay, then the company is planning to develop, company is developing a new smart television and all $1.6 million incurred to date will be capitalized within intangible asset. So what is the risk here whenever there is intangible assets? There is a risk that this expenditure has not been recognized as per IAS 38. Hence, intangible assets may be misstated. Okay. Response: discuss with finance director or management, discuss with finance director and assess whether all expenditure has been recognized in accordance with IAS 38 or not. Okay, these are the things we have already studied in class, that whenever there is intangible asset, we refer to IAS 38, that this expenditure is not recognized as per IAS 38, hence assets may be misstated. And response: discuss with finance director whether all expenditure has been recognized in accordance with IAS 38 or not. In May 2005, a payroll clerk was dismissed as he carried out number of fraudulent transactions. So when someone is dismissed and fraud was identified, there is a risk that extent of fraud not yet been identified. Hence, profit may be misstated. You know, when you dismiss someone for fraud, you can never recognize the extent to how much fraud he has done. All fraud must be written off to P&L. So you haven't identified the fraud, that what, let's suppose you say only 4 transactions are fraud, but he may have done many transactions. There is always a risk that the extent of those transactions are not yet recognized. Hence, they are not written off to profit and loss account. Hence, P&L may be misstated. And whenever there is fraud, the audit team shall maintain professional skepticism and remain alert to any further risk of fraud and error. Okay, so you can write these 3 more points. Okay, a clerk was dismissed due to fraud. Always remember, when there is a fraud, you can never recognize how much fraud extent was, how many transactions were there in fraud. And since they are not recognized, profit may be misstated because you wouldn't have charged any fraud. Impact should be charged to P&L. You haven't charged them. You don't know the extent, so profits may be misstated. An audit team shall maintain professional skepticism and remain alert throughout the audit. Please copy them. Now, one last risk we can find from here, that the external audit team may rely on controls testing carried out by internal audit department. So audit team may rely on controls testing carried out by internal audit department. This is on audit risk, that you're relying on controls of someone else. There is a risk that weak controls testing by internal audit department and relying on these controls may increase detection risk. Okay, you are relying on controls of some service organization or your internal audit department or company's accountant. So if you are relying on someone else's control, there is always a risk of weak controls, which increases detection risk. Review the reports and files of work done by internal audit department to assess strength of controls. In addition, reperform some tests carried out by internal audit department to assess their adequacy. Okay, so whenever you're relying on controls of someone, whenever you rely on someone else's control, there is always a risk that their controls are weak. Like we have done this point in some previous questions regarding you are relying on controls of service organization. So there's always a risk that their controls are weak, leading to increased detection risk, because if you rely on their controls, you won't be able to detect errors because their controls are weak. If you rely on their controls, on weak controls, that means you won't be able to detect something because there are weak controls. This increases detection risk, and you can review the reports of their work done to assess how well they're doing, and you can re-perform some procedures to assess whether they're adequate or not. Okay, so that's it for 8 audit risk. Please copy this.